In this video, I'll explain what trusts are, who uses them, and whether they can actually help you to pay less tax. I'm a qualified accountant and experienced tax professional. Let's start off by looking at what a trust is. You've probably heard of the term trust fund baby and imagine an overprivileged child with millions in the bank who never has to work a day in their life. Actually, people with trust funds are usually normal people who don't live luxurious lives. I spent part of my career preparing tax returns for trusts, and they're not all that uncommon. A trust is just a way of managing your assets, so it could include property, land, artwork, cars, money, and instead of just giving those assets away, you set them aside and then you can choose the terms and conditions or a set point in time at which you want those assets to go to a defined group of people. Trusts typically involve three roles. There'll be the settlor, and that's the person who puts the assets into the trust. There is the trustee, and that's the person who manages the trust. And then there's the beneficiary, and that's the person who gets to benefit from the trust. So why would you want a trust? There are a few different reasons why somebody might want to set up a trust. The most common one is to protect and control a family's assets. So usually when assets are put into a trust, if the beneficiary goes through a divorce or a bankruptcy later on in their life, those assets are not automatically part of the assessment that will happen as part of that divorce or bankruptcy. So in that sense, it could help to protect the assets that have been passed on to the beneficiary from their family. Another reason is to manage the assets of somebody who's too young to manage their own assets or somebody who's incapacitated. And then finally, it could be for tax planning reasons, which we'll talk about later on in the video. So to illustrate how a trust could work, let's say there's a grandparent who wants to pass on some assets to their grandchild. Say it's some money and classic cars. In this scenario, the grandparent is the settlor. The grandparent decides that the parent should manage the assets on behalf of the grandchild. So the trustees are the parents. The parents have legal ownership of the assets in the trust, but they don't have a right to the benefits of the assets themselves or any income that the assets produce. Instead, they just need to make sure that the rules set out in the trust deed are followed, and in that sense, they just need to make sure that they meet their fiduciary duty. The beneficiary is the grandchild. This is the person who will have the right to the assets and any income that's generated from the assets once all of the terms and conditions in the trust deed have been met. A trust is different to a will because as soon as the trust deed is signed, the settlor gives up any right to the asset and it passes into the trust. And this can happen whilst the settlor is still alive. Now let's talk about the different types of trust. There are a few different types of trust, but three of the most common ones are the bare trust, the discretionary trust, and the interest in possession trust. First of all, the bare trust is the most common and simplest type of trust. It's also the easiest one to set up. This type of trust is usually used for young children, and it's commonly used where a grandparent wants to pass on an asset to their grandchild, but they don't want them to have control over that asset until they're 18 in England and Wales or 16 in Scotland, because at those ages the asset automatically will pass on to the beneficiary. The beneficiary has to be named and can't be changed. So they're not very flexible in that sense. And there are tax benefits to a bare trust, which I'll discuss in the next section. There's then the discretionary trust, and with this type of trust, the trustee has more discretion over when the assets pass to the beneficiaries of the trust. The beneficiaries also don't have the present right to the enjoyment of the income generated by the assets in the trust. Instead, a lot of power is given to the trustees. The trustees can decide when payments are made to beneficiaries, which beneficiaries receive payments, and when the assets can pass on to the beneficiaries. These types of trusts are more flexible than bare trusts because you don't need to separately name all of the beneficiaries. Instead, you can have a class of beneficiaries, so it could just be grandchildren, and then any unborn grandchildren will also become beneficiaries of the trust later down the line. So these types of trusts are good if you don't know which beneficiaries will need the income, and they're also a good way of protecting your assets because the beneficiaries don't have a right to the assets, which means that their creditors don't have a right to the assets either if they face bankruptcy later on in life. And then finally, with an interest in possession trust, the trustee has to pass on any income that's generated in the trust to the beneficiary. But the beneficiary doesn't have a right to the underlying assets owned by the trust. This type of trust is commonly used where a person has been divorced before and has a new partner. The beneficiary will be the new partner who is an income beneficiary, and that means that they can benefit from all of the income generated by, say, shares held by the trust. But then when the settlor passes away, those shares would pass on to the settlor's children from their first marriage. So now let's talk about the tax implications. Trusts can be helpful in paying less inheritance tax, but this is only helpful if your estate falls within the charge to inheritance tax in the first place. And actually in the UK, only 4% of estates are subject to inheritance tax. So for most people, this isn't really a concern anyway, although more and more people are falling within the charge to inheritance tax. I'll link a separate video that I made all about inheritance tax at the end of this video. Essentially, by transferring your assets into a trust, you give up your right to them, and that means that they leave your estate. And then if you survive for at least 7 years after transferring those assets into the trust, they may not be subject to inheritance tax. There are different rules for interest in possession trusts because they can have a 10-yearly inheritance tax charge instead. There can also be income tax benefits in using a bare trust. So with a bare trust, the income that's generated from any underlying assets is deemed to be the child's income and can be taxed at the child's marginal tax rate, as long as the assets put into the trust weren't put in by the child's parents, because in that case, the income would be taxed on the parent instead. So with a bare trust, a grandparent could put a rental property into the trust, and any income generated from that property would be deemed to be the child's income. And so the child could use their tax-free personal allowance and potentially not have to pay any income tax on the rental income that's generated through that rental property that's held by the trust. Trusts are complex and they have their own tax rules and charges, so it's important to consult a lawyer and a tax advisor if you're thinking about setting up a trust. But I hope this video was helpful in giving you a quick overview of how trusts work in the UK. If you like this video, then don't forget to subscribe, and I will see you next time.